Right now, Bitfarms Ltd is trading at $5.86 Canadian CAD, down just a fraction, a penny, representing a dip of 0.17% on the day. And right away, that tiny movement tells a story that most people are missing. The immediate expectation for any Bitcoin miner is that its chart should be a mirror image of Bitcoin's. But the fact that Bitfarms is holding relatively steady while the broader crypto market is experiencing its usual intraday chop points to a deeper reality. The market is starting to price in factors far beyond the simple spot price of Bitcoin. There's a battle for survival and dominance happening in the mining sector, and Bitfarms is right in the middle of a corporate drama that could define its future, making it a far more complex investment than a simple proxy for a digital asset. Most investors, especially those using accessible platforms like the Robinhood app or engaging in SoFi active investing, look at a stock like Bitfarms and apply a straightforward logic. They believe the company's value is almost entirely dependent on the price of Bitcoin. When Bitcoin rallies, miners who are paid in the asset see their revenues and margins expand, and their stock prices should follow suit. Conversely, when Bitcoin corrects, these companies should get hit even harder due to their high operational leverage and fixed costs. This is the common narrative, the expectation that drives a huge portion of the trading volume. It treats mining stocks as leveraged ETFs on crypto, a way for people to add exposure to their individual brokerage accounts at places like Fidelity or Interactive Brokers, without the complexities of self-custody. And for a long time, this perspective wasn't necessarily wrong. It captured the primary driver of the sector's performance. However, sticking to that view today is like trying to navigate a highway by only looking in the rearview mirror. The reality of the post-halving environment is that the game has fundamentally changed. The Bitcoin block reward, the primary source of revenue for miners, was cut in half earlier this year. This event was a planned culling of the herd. Suddenly, operational efficiency isn't just a talking point in an earnings call, it's the single most important factor determining which companies will thrive and which may face insolvency. The new equation is about who can produce a Bitcoin for the lowest all-in cost. This includes energy prices, fleet efficiency, the performance of their mining rigs, and overhead. Bitfarms' story is no longer just about the price of BTC. It's about hash rate expansion, energy procurement strategy, and corporate governance, especially in light of the recent hostile takeover bid from its larger competitor, Riot Platforms. Looking at the stock's recent performance reveals this growing disconnect from being a pure Bitcoin beta play. Over the last month, we've seen days when Bitcoin was flat, yet Bitfarms saw significant buying pressure. This was directly tied to news about their operational updates, such as the progress on their new 100-megawatt site in Yguazú, Paraguay, which promises access to cheap, stable hydropower. An investor simply charting BTC against BITF would be confused by these divergences. Institutional desks at places that offer Fidelity wealth management or use sophisticated tools on the Interactive Brokers platform are not just looking at crypto prices. They are modeling electricity costs in Argentina versus Quebec and calculating the payback period on the latest generation of mining hardware. The slight intraday dip we see today is less about Bitcoin's minor fluctuation and more about the market digesting the ongoing power struggle with Riot and what it means for shareholder value. The trading volume is moderate, suggesting that while the day traders are quiet, longer-term investors are holding their positions, waiting for the next major development in this saga. The backdrop to this is, of course, the broader market. When we see volatility in tech giants like Apple stock or Nvidia stock, it creates a risk-on or risk-off sentiment that spills into speculative sectors, including crypto mining. But macro pressures are also uniquely important here. Inflation and interest rate policies directly impact the cost of capital for these firms. Bitfarms is in a constant cycle of capital expenditure, needing to buy the newest, most efficient mining rigs to stay competitive. When borrowing costs are high, that expansion becomes more expensive and puts pressure on future profitability. So, while a retail trader on SoFi Invest might be watching the Bitcoin chart, the CFO of Bitfarms is watching the statements from the Bank of Canada and the U.S. Federal Reserve just as intently. For those unfamiliar with the core business, Bitfarms is fundamentally an industrial-scale Bitcoin producer. It operates large data centers, primarily in Canada, the United States, Paraguay, and Argentina. Inside these facilities are tens of thousands of specialized computers known as ASICs, application-specific integrated circuits, that run 24/7, consuming massive amounts of electricity to solve the cryptographic puzzles that secure the Bitcoin network. In return for this computational work, Bitfarms is rewarded with a certain number of new Bitcoin. Their business model is therefore a function of three main variables: the price of Bitcoin, revenue, the cost of electricity, primary expense, and their total computational power, or hash rate. Their vertical integration, including their own electrical engineering and repair facilities, is a key part of their strategy to control costs and maximize uptime. The company's past reports have consistently highlighted their focus on diversifying their energy sources and geographic footprint to mitigate risks associated with any single jurisdiction or power grid. The future outlook for Bitfarms is where the tension between expectation and reality becomes most pronounced. The biggest overhang and, paradoxically, the biggest potential catalyst is the unsolicited acquisition proposal from Riot Platforms. The expectation might be that an acquisition by a larger US-based player would be an immediate win for shareholders. Riot's initial offer presented a premium to the trading price at the time. However, the reality is far more complicated. Bitfarms' board rejected the offer, implementing a poison pill to prevent a hostile takeover. They argue the bid fundamentally undervalues the company, especially its premium operations and growth pipeline. This corporate battle forces investors to ask some hard questions. Is Bitfarms' management entrenched and acting in their own self-interest, or are they correct that the company's standalone plan, focused on its South American expansion and fleet upgrades, will create more long-term value? The outcome of this struggle will be a defining moment for the company. If Riot comes back with a higher offer that the board accepts, shareholders could see a quick and significant return. If the defense holds and Bitfarms executes on its growth strategy, the upside could be even greater, but it also carries more execution risk. Another significant factor is their operational execution. The company is targeting a massive increase in its hash rate and energy capacity. The expectation is that these new sites will come online smoothly and begin contributing to their Bitcoin production. The reality is that large-scale construction and energy projects are rarely without delays or cost overruns. Any hiccup in their expansion timeline could be punished by the market, while successful, on-schedule deployment would build confidence and likely lead to a re-rating of the stock. Investors looking for investment help or considering options like Schwab Intelligent Portfolios should understand that this is not a set-it-and-forget-it type of stock like a blue-chip dividend payer. It is a high-growth, high-risk play on the future of digital assets and industrial computation. Comment below with your thoughts on this. Do you believe Bitfarms should accept an improved offer from Riot, or should they remain independent? The risks are clear and significant. A sustained downturn in the price of Bitcoin below their all-in cost of production would be catastrophic, forcing them to either sell their holdings at a loss or shut down operations. Regulatory risk also looms large. While their geographic diversification helps, a coordinated G7 crackdown on crypto mining could have a chilling effect on the entire industry. Competition is also relentless. The global hash rate is constantly rising as more miners come online, meaning everyone's slice of the pie gets a little smaller every day, unless they are also expanding. This is an arms race for efficiency, and standing still means falling behind. For anyone using online investing sites, it's critical to see this not as a tech stock like Tesla stock, but as an industrial commodity producer with a very volatile underlying commodity. In closing, the story of Bitfarms today is so much more than its fractional percentage change. The common expectation is to view it as a simple leveraged bet on Bitcoin. But the deeper reality is that this is a company at a crossroads, navigating a brutal post-halving competitive landscape while simultaneously fighting off a hostile takeover attempt from a larger rival. Its future value will be determined not just by the crypto markets, but by the strategic decisions made in its boardroom, the operational execution of its engineering teams in Paraguay, and its ability to continue producing Bitcoin at a cost that ensures profitability. The tension between the simple narrative and the complex operational and strategic reality is where the true risk and opportunity lie for any investor considering this stock for their portfolio, whether through a DIY Fidelity account or a more managed